When you walk into a bank and ask for that business loan, you probably spent weeks polishing your balance sheet, your tax returns, and your profit and loss statements. But there's a quiet line that's sitting on your P&L that you probably didn't even think twice about. A line that lenders are looking at very, very closely to see if your business is secretly a ticking time bomb. And I'm talking about your commercial insurance premiums. Now, most founders, they see insurance as just another monthly bill, kind of like a necessary evil. But to a bank underwriter, your insurance premium, it's not just an expense, it's a highly accurate third-party report card on how risky your business actually is. And today, we're breaking down exactly why lenders look at your insurance premiums and what high numbers signal to them and how you can fix it before you apply to that next loan. So I'm not a CPA, so always be sure to check with one for any tax or financial advice. But today, we're going to understand how the insurance premiums affect your chances for a loan. So to understand why this matters, you have to understand how banks think. Banks, they hate losing money, like we all do. Their entire business model is built on assessing risk. So a bank underwriter, they know financial data, but they might not know how the exact day-to-day operational hazards of your specific industry work. And you know who does? Your insurance company. Insurance companies, they employ armies of actuaries, data scientists, whose sole job is to calculate the mathematical probability of your business failing, catching fire, or getting sued. So when a bank looks at your financial statements and sees a massive spiked premium for general liability or workers' comp, they don't just see an expensive line item. They see a massive red flag that says the insurance company knows something bad about this business, and they are charging a premium to cover it. So let's look at 3 specific things a high or spiking insurance premium reveals to potential lenders. Number 1, a history of claims. If your workers' compensation or general liability premiums are abnormally high compared to your industry peers, it usually means your business has had a history of claims. To a bank, a history of claims means poor operational management, unsafe working conditions, or a product line that's prone to defects. If you can't keep your workplace safe, how can they trust you to manage a $500,000 line of credit? Number 2, high risk operations. Sometimes it's not your history, it's just the industry that you operate in. If you've expanded your business into a high risk sector, your premiums likely skyrocketed. If the bank sees this premium hike before you've proven the revenue that can come from it, they see cash flow mismatch that could result in a loan default. And number 3, exposure to environmental or cyber catastrophes. Easy for me to say. Are your property or cyber insurance premiums like through the roof? The bank translates that directly into, hey, this business is one hack or one flood away from going completely under. If your collateral, like your building or your inventory, is in high jeopardy, the bank's security is in jeopardy. 3, how to turn the tables. Now, this really doesn't mean that you should try to underinsure your business just to make sure your premiums look lower. In fact, underinsuring is even a faster way for a loan application to get rejected. Banks require specific minimum coverages in order to protect their investment. So instead, here are things you can use for your insurance portfolio to actually impress a lender. Tip number 1, provide the narrative. If your premiums are high due to like a single pass claim, don't wait for the bank to ask. Attach a letter of explanation to your loan application. Explain what happened, what the insurance covered, and most importantly, what safety protocols you implemented to ensure that that never happens again. And tip number 2, show off your risk management skills. Show the lender your written safety programs, cybersecurity protocols, or disaster recovery plans. Prove to them that you are actively working with your insurance broker to lower your risk profile. Tip number 3, leverage your broker. Ask your commercial insurance broker for an insurance summary or risk assessment report that highlights your business's strengths. A glowing review from a top tier carrier can actually act as a character reference for your business. So keep in mind these tips and these things that a potential lender will look for. And before you actually even apply for that loan, your books have to be clean and spotless. And if you're in need of a bookkeeper, I am a certified QuickBooks ProAdvisor, and I can help get your books clean and ready for that loan application. Thanks for watching, and we'll see you in the next one.